Mohamed El-Erian with us of Pacific Investment Management Company. Dr. El-Erian, good noon to you.
Good afternoon, Tom.
Such a difference in my study, my amateur study, between Libya and your native Egypt. They're truly worlds apart. What is the common ground you see now between Libya and the events of last week in Egypt?
I think, Tom, a common factor that's been driving all that is a combination of youth unemployment, high food prices, and political repression. But as you say, Libya is different. The revolutions in Tunisia and Egypt were relatively peaceful. Libya is far from being relatively peaceful. There's a tremendous amount of human suffering and casualties there, and it makes this process more unpredictable and more dangerous. In addition, Libya is a major oil exporter, so suddenly developments in North Africa and the Middle East have systemic impact on the global economy.
How do you believe the other oil producers will react in the Middle East when they see the events of this weekend and today in Libya? How will Saudi Arabia react or Kuwait react?
You know, everybody in the Middle East and beyond is understanding that this is a process, a movement that has to be taken seriously, that it's better to be ahead of the curve rather than behind the curve. The story of Egypt, Tunisia, and Libya have been regimes that have been consistently behind the curve. So the lesson that has gone out to not only other Middle Eastern countries, but to the whole world, is take seriously these economic issues and these political issues.
Here's a chart, folks. Let's bring it up. Dreaded first chart. And, you know, I like the organ there because the legitimacy of a country's data is the question. Even right on the Bloomberg, it says we're really not sure of this oil production data for Libya. Mohammed, there's a huge mystery here with Libya. I recall the collapse of the Soviet Union, and we were questioning the Russian data and our intelligence. How good is our political and our economic intelligence for Libya?
On the economic side, Tom, the data that you can confirm on the other side, particularly trade data, where there's a trading partner and therefore you get another number, tend to be pretty good. And they tell you that Libya is an exporter of about 1.5 million barrels a day, which is not insignificant. This is one of the top 10 or 11 oil exporters. When it comes to internal data, GDP numbers, inflation numbers, then it becomes more difficult. And on the political aspects, what we've learned is that the Western intelligence has been behind the curve in terms of understanding the dynamics in those countries.
Let's bring up the op-ed today from El-Erian in the FT. Again, here looking at Libya and the events of the weekend. This weekend I also saw a change in dynamics, and one that makes a transformational period even more unpredictable and dangerous. What can the Western world do, Dr. El-Erian, over the night besides get their people out of Libya? Do you see a political dialogue of any shape or form that's feasible in the next 48 hours?
Three elements, Tom. One is the reality that in countries like Libya, the rest of the world cannot do very much other than condemn and try to put pressure, but ultimately that's not going to bear very much. Second, in countries that have gone through the first phase of the revolution, Tunisia, Egypt, the West is able and willing to step in to help the process towards democracy. And it's very encouraging that the British Prime Minister went to Egypt yesterday. Thirdly, we got to appreciate in the West that what's happening in the Middle East and North Africa it results in stagflation in the short term. So higher inflation and lower growth because of higher oil prices that take away purchasing power and transfer wealth somewhere else, because of higher geopolitical risk, which tend to diminish animal spirit and therefore impact investment. And let's not forget that the Middle East is a market, particularly for European exports. So from an economic perspective, it's important for the West to understand that these are stagflationary winds that have been added to the global economy.
Let's continue with Mohamed El-Erian of PIMCO. Mohamed, I want to play this note here on your stagflation. Earlier this morning on Bloomberg Surveillance, I spoke with Stephen Schork of the Schork Group, and I asked him what he expects for the price of gasoline.
We already have $100 a barrel here in the U.S. It's just not being reflected in the futures contract. This is going to be the ugliest summer since the oil bubble of 2008.
Steve Shork there on El-Erian's Stagflation. Mohamed, I'm glad you brought that up. I mean, here we are, and all of our viewers worldwide know it. We get inflation with lack of growth. Is that a new normal to have a persistent stagflation, or is that just something for, say, the first 6 months of 2011?
The new normal, Tom, is just a recognition that the Western world is not going to grow as rapidly as it did before, that unemployment will be a persistent issue, that social safety nets are going to be very stretched, and that government intervention will continue in the economy. What we're getting on top of that now are headwinds from higher oil prices, higher geopolitical risk, and a concern that one of the reactions to higher commodity prices will be for consumers to stockpile. So I suspect that right now a lot of airlines are saying, with oil where it is now, should we be hedging now, right? So what you get is an overshoot, just like we saw in 2008. And that's the concern in terms of the stagflationary headwinds.
Well, here's a headline just across a Bloomberg. Gaddafi warns he may have to purge Libya house by house. I think that's what's called geopolitical risk, Mohamed. And when you do this, how do you react as an investor? Did PIMCO have a meeting this morning where you said lighten up on emerging markets?
Now, you know, last week, Friday in particular, when the crisis started impacting countries like Bahrain, we recognized that it was morphing, that it would have an impact on commodity prices and oil prices in particular. So we identified a process of morphing that went on. When the crisis was focused on Egypt and Tunisia, when those countries were going through their peaceful revolution, they were not systemic in nature. Their influence on the global economy were limited. They weren't large economies, they weren't major exporters of commodities, and they didn't owe anybody lots of money. When the crisis started hitting and the turmoil started hitting Libya and Bahrain, this whole phenomenon has morphed. And it has morphed into something that in the short term means higher oil prices, greater risk aversion, and a somewhat flight to quality, although it's interesting to see that the dollar hasn't benefited that much.
Yes, I thought that was remarkable. The dollar. Elian, bring up a dollar index, DXY index. Get that up for us in the next couple of minutes. Just a daily chart back about 6 months. Here's a chart, folks. Too much information, and it's not my best too much information ever, but it's a Monday. It's a Tuesday rather. After a long weekend, give me a break. Oil breaks out. Here's oil, Mohamed. We're up there at 140. Down we go, and it's just been this grind. My experience, Mohamed, is when you get a grind like that, it usually works out. Do we just assume higher oil prices? You know, 110,
the global
120?
economies, sure, the global economies are going to have to live with these higher oil prices for a while, and that's just the reality of the world we're living in today.
When you look, I want to bring it back on the time we've got left, Mohamed, back to Egypt. What have you seen in Egypt in the last week? Does it give you cheer to see Egypt trying to get on to February and on to March with what we've seen in the last week?
Oh, they've taken important steps. You've seen ministerial changes, you've seen a timeline announced, and most importantly, you've seen the movement, the protest movement saying, you know what, we're going to be the check and balance here. We're going to make sure that this revolution that was started will end up with democracy and great individual freedom. So we're seeing progress. It's a bumpy road, Tom, and it doesn't happen overnight, but we're seeing every day, we're seeing progress. One
more chart. Dollar index here. As Dr. El-Erian said, the dollar really not surging today, although Swiss franc came in stronger, Swiss franc against the euro. There's DXY, and it's been a weaker dollar. Mohamed, what does a weak dollar signal to you? What is a dollar signal that can't jump up here on a day like we've seen today and the weekend?
It's a warning shot to America that we cannot simply assume flight to quality, flight to safety, that people are starting to worry about the fiscal situation in the U.S. They're starting to worry about the level of debt. They're starting to worry about what they hear about states and municipalities. So I would take this as a warning shot that we cannot assume that we will maintain the standing of the reserve currency as we have in the past.
Dr. El-Erian, thank you so much. Mohamed El-Erian, folks, with PIMCO.